Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Saturday, May 3rd, 2025. Today's episode begins with our headline, Markets in Limbo, Crude Oil Screams Recession, Healthcare Shows Complacency. I listened to a lot of chartists with a lot of different indicators and methodologies, and the reason I say markets are in limbo is because everyone is disagreeing here what's happening next. I'm hearing many people are saying that we'll at the very least see a pullback from this 5,700 area before potentially going higher, potentially getting to a double top back to the all-time high, potentially getting to all-time highs, potentially before rolling over. I'm hearing some people say that this may act as the pivot point to head straight down. One thing I'm looking for is really what happens Monday. Are we going to start fighting here and then, set up like a bull flag kind of a thing to head to the upside? Or are we going to see a larger move straight back down in more of a blow off top kind of a formation? My take on it is that we are in limbo. One of the main things that is convincing me and many other people that the downside is clearly not over is what we're seeing in crude oil. It's May. It's the beginning of the summer. This is when crude oil is supposed to shine. This is when the traders come in and load into oil because they know how much people are going to be driving in the summer months. Crude oil is supposed to go to the moon right now, and it's very, very weak. At the very end here, I'll scroll in a little bit here. We are at multi-year lows. We have not seen crude oil this cheap since 2021. And I want to emphasize that it's not like crude oil has found new highs and is staying there. We have seen this price all the way back, as far as this current chart goes, all the way back to 2018. If the dollar is dead and inflation is out of control, crude oil would not be priced at the same price that we've seen in 2018. Now, some people might be saying, oh, well, it's OPEC. OPEC Plus is, just ramping up their production for whatever reason. Well, yeah, but why? Why are they ramping up their oil production? The way I look at it, they're trying to squeeze every last dime out of oil before it continues to go even further to the downside. Any way that you look at it, crude oil is currently acting like we are headed into a major, major global economic slowdown. While the S&P 500 has gotten some legs recently in its price, I am going to repeat right now, we are currently in crude oil at a price of $58.35, a price not seen since, looks like, April of 2021. The third part of today's headline is Healthcare Shows Complacency. I haven't talked about this before on the show. This is XLV. It's an ETF of the healthcare industry. Now, while the PE ratio of this industry is around 28, around the same as the S&P 500, and the price may have gotten a little too excited post-pandemic, I want to point out, since September of 2024, we've been finding very clear lower highs and lower lows here, not anything like what we're seeing in the S&P 500. But more importantly than that is comparing XLV to SPY, the S&P 500 index. If you put XLV divided by SPY, I want to point something out here. This is very, very low when you look at simply price performance over the past 15 years plus, 20 years, I guess we can call it. All this chart is really doing is comparing the price movement of the healthcare industry to the S&P 500. The healthcare industry as a whole is poised to outperform everything by a long shot over the next few decades when you consider that the wealthiest generation in the entire history of the United States is the baby boomers, and they will be using healthcare services over the next few decades. A lot of money will be going into healthcare, I guarantee it. While we've seen this ratio rise from 1999 all the way up through 2015, since 2015, this ratio has cooled off gradually and then recently cooling off more violently. I also want to point out that you do see this pattern going into major bear markets, recessions, etc. 1999, going into the dot-com bust, we were headed lower before exploding higher. Going into the great financial crisis, we were going down, 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 down before exploding higher. Just to perhaps emphasize my point even more clearly, since March of 2025, Fartcoin has gone up by 400%. While the healthcare sector of the United States has been falling. My crystal ball says that there may be a little bit of complacency here. But what do I know? I'm just a guy with a crystal ball. I am not in the camp that believes that we are back into bull mode. There are many charts to help emphasize my point that we will go through in a moment before we get their community topics. What moves, if any, did you make today? If you caught my quick update on Friday after market hours, you know that I sold my gold short GDXD at about a 21% profit. The miners found new intraday lows, and so I was able to sell out of that fund at $4.99. As much as I think gold is likely to head lower here, you can't go broke taking profits. And holding shorts feels like a slow burn in your hand. So I'm out. Coming up next week, I'm sure we'll have more continuous tariff updates as always. We also have on Wednesday the FOMC meeting and decision. Currently, it's at a 97% chance of no cut. At this point, they kind of have to play dumb because the stock market bounced up so much, is kind of how I'm looking at it. And then with this past Thursday's initial, continuing jobless claims finding new highs that we haven't seen for 3 years. This next Thursday's initial and continuing jobless claims could really be a big number, especially if it shocks us to the upside. As always, thank you so much for watching, subscribing, commenting, and supporting the subscription buttons right over here if you missed it. These are the daily reminders explained in a link on my website in the description of this video. The crystal ball readings remain the same. The Robschild portfolio has one update. I am no longer short-term holding that gold short anymore. I am still short semiconductors. I'll explain my thoughts on the semiconductor chart when we get there. Let's look at the charts. S&P 500, the SPX on Friday went up by 1.47%. If you did buy the dip here, you were very handsomely rewarded. I question the sanity of anybody that's buying right now for all the reasons I already mentioned and a lot of other items that I'll bring up today. One thing that supports this move up is the advanced decline line now rose along with this. This is actually a bullish sign. And when we look at one day by sector performance, everything green, everything went up on Friday. A big piece of this was the PCE data that came out Friday. Inflation gauge wasn't too hot, and the jobs that were added seemed pretty strong. The unemployment rate remained flat at 4.2%. So the market's just forgetting about oil being in the toilet for now. The fact that GDP is negative for the quarter. My take on it is that it's a bull trap like we've never seen, where you trap all the bulls into thinking that things are going up before we head lower. Bitcoin tends to be a good indicator of global liquidity, and it hasn't been able to get up to that psychological $100,000 mark, just kind of struggling here. The longer it struggles, the more I'm convinced we're actually going to be heading down in Bitcoin very soon. Next, I want to bring up the VIX, pricing of options contracts, volatility index, otherwise known as the fear gauge. We dropped to 2267, still above 20. The main level 20, anything above 20 is still fear mode. And also, obviously, when we look at the VIX futures term structure, it's still completely in backwardation. Add to this that the fear and greed index on CNN business website, even though the stock market went up from Thursday to Friday, we went from a reading of neutral 47 back down to a level of 43, back into fear mode. Also, while the VIX is dropping, so I'm not sure exactly what caused this. I just find it very interesting. With the jobs data coming out apparently stronger than what some of the Treasury market was expecting, we had a rise in yields, including the 2-year Treasury. So we'll see where we go from here. But as it stands right now, this is saying, yeah, we'll probably see a little higher for a little longer. It sort of feels to me at this point that the FOMC is in a very clear position of like, hey, we can't do anything, inflation is fine, the jobs market is fine, there's nothing we can do. Even though, I mean, there's very clearly very smart people that work there and run things there. They know what's going on, and they're forced to not react to what's going on behind the scenes. Even though they probably can see what's coming within the next few months, they kind of are forced to, be driving their car looking just, on the road directly in front of them instead of, the semi truck coming at them. If things were truly fine and going higher, we would not only need to see the VIX get out of backwardation and back into contango, but we would need to see copper rising. Dr. Copper, with a PhD in economics, is not convinced here. Muted moves, and also still in a pattern currently of a lower low and a lower high. Despite crude oil over the past 5 trading days going lower and staying lower, long duration yields have been going a bit higher, but TLT finding a support line connecting Friday, April 11th to Monday, April 21st. That's where the technicians bought. That's where the technical support was. On Friday, I think for all reasons under the sun, it would make sense for this to continue higher. I also want to note that with the S&P 500 going up at the same time as TLT going down, we are now in an uncorrelated state. And when we enter uncorrelated state, we can stay there, and we can get to that point where, yes, indeed, if the S&P 500 from this 5,700 level does just drop, the TLT should be going up from here, like very obviously. There's also a lot of support for TLT potentially continuing to rise while its price went down and yields went up. The move index actually dropped to find new lows that we haven't seen since the end of March, and it's going down, not timidly but pretty quickly. Another sign that tells me we're most likely headed lower in stocks in the short term is that we're still in a longer term trend of credit spreads still widening here, even though more recently we've had a shorter term trend of credit spreads tightening. I do have to add here that we do have to take this chart with a bit of a grain of salt, because this spread can just go sideways from here, and that would actually potentially give legs to the market to go to the upside. But it's just really important to keep an eye on these credit spreads. If we get to new highs above April 7th's high, for example, that just strips the legs right out of the bottom of the market, especially if you see strength in stocks and credit spreads continuing to widen, which may end up happening. I just need to stress the importance of keeping an eye on credit spreads. Next, I actually want to bring up the put to call ratio. I don't need super fancy methodologies to see the fact, let's scroll in so you can see better, that the put to call ratio has dropped, which gives room for the market to potentially drop. Whenever we see a peak in the put to call ratio, it means everybody's bearish and, you know, going to make a lot of money if the market continues to go lower. And so while, you know, the market tends to try to seek out how to cause as much pain as possible, that's largely what we've seen with this rally. And I am still in the camp that this is a bear market rally. There are others that are saying, no, this was a dip and we're just continued higher. I'm not convinced when you combine everything together, especially crude oil. Crude oil is supposed to be spiking here and it is dropping. Stocks and yields, I believe, are set up to follow, dropping, and the put call ratio seems in like it's back into a zone where we can roll over to the downside and cause more pain actually to go to the downside than the upside. I am expecting markets to go down this following week. Last chart of the day, I also brought this up in my quick update. I am still holding a fund called SOXS, short semiconductors. However, if you look at it on a daily time frame or a weekly time frame, this head and shoulders that I've been so excited about has officially failed. This is no longer in play. So I'm going to delete it and we're going to forget about it. And instead, I'm going to use this blue line, which I got from other better chartists than me. It connects October of 2022 to October of 2023, and although we broke down below it and tried to retest it, now we confirmed above it. Because of this, I am looking to exit my short now at minimal loss. I am expecting to, at the very least, get back down to this area where there was the fight. You know, you gotta come back to the scene of the crime, as they say. Even though I strongly believe and feel with my emotions that this is headed a lot lower, the chart pattern is too much against me at this point. So I will be exiting here because we could end up seeing a thing where we get down to this range and then see some movement higher before eventually, I assume, still going down. But I don't know. What do I know? I'm just a guy with a crystal ball. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching and see you next time. Robschild.